Hi everyone, this is Professor Gallagher. In this video, we're going to talk about the topics that are included in Chapter 3, Gross Income Inclusions and Exclusions. The first thing that we're going to talk about is when that we should recognize income for tax purposes. The income recognition rules for tax purposes are very similar to the recognition rules for accounting purposes, that income must be realized and earned before it is taxed. However, there are three additional conditions that must be present when the transaction occurs. There must be an economic benefit of the transaction. The transaction must have come to a conclusion, so we can't be in the middle of a transaction and apply taxes to that transaction. The income for the transaction must not be a tax-exempt income. And we'll discuss tax-exempt incomes a little bit further in the chapter. There are certain incomes that are excluded from tax. The cash receipts and disbursements method is used by almost all individuals when they file their tax returns. The constructive receipt principle states that income should be reported in the year that the taxpayer receives the right to control the income rather than in the year that it is earned. Receipt of property or services will trigger income recognition. So the constructive receipt rule means that, like, if a taxpayer has a mailbox that all of their paychecks are sent to, and they don't check the mailbox for the entire month of December, although their paychecks are sitting in the mailbox, they have the right to control when that income is deposited and they've received it. So all that income that is sitting in their mailbox in December would still be taxable in that prior tax year, which includes December, even though they haven't deposited or used those funds. So if the taxpayer provided consulting services to a friend, and in exchange, the friend fixes the taxpayer's car, you and your friend must report on both tax returns the fair market value of the services that were provided. The answer to this is true. According to the tax law, you have received an economic benefit, the transaction is concluded, and that income should be recognized on both taxpayers' tax returns. So next we're going to talk about interest. This interest is usually taxable. Interest from bank savings and loans or credit unions is going to be reported to the taxpayer on a 1099 INT. Interest earned on Series E and EE U.S. savings bonds is taxable, but can be reported gradually on an annual basis or fully at maturity. So you have an option there whether to report the interest that's earned on a yearly basis or whenever that bond is mature. Some interest that taxpayers received is tax exempt if that debt is issued by a state, U.S. possession, or like a county or city. There are other types of interest that must be reported if there is a seller financed mortgage. So if you own a house and you sold that house and you are holding the mortgage on that paper for the buyer, then payments that have been received from that, the interest that was earned on that mortgage must be reported. Installment sales should be reported for the income, for the interest income, and any imputed interest on loans that were made at below market interest rates. We're going to talk about that later in the chapter. And also interest on bonds that were sold between interest dates. Interest is going to be reported on Schedule B of Form 1040 if that amount of interest is more than $1,500. If it's less than $1,500, you can typically report that directly on the 1040. Dividends are distributions that are made to the shareholders, and that is considered income that should be reported on the tax return. Qualified dividends are made from the earnings and profits of the payer corporation and are from domestic corporations or qualified foreign corporations. So you'll know that if the dividend is qualified or not when you receive their statement from your brokerage house. It'll state whether that dividend that was paid is ordinary or qualified. The Tax Cuts and Jobs Act of 2017 provided for taxability of qualified dividends at different tax rates, depending on the taxpayer's taxable income thresholds. Prior to this, it was based on their marginal tax rates, but this was changed in 2017. For married filing jointly households with taxable income of less than $77,200, head of households with taxable income of less than $51,700, and married filing jointly, separately, or single with taxable income of less than $38,600, qualified dividends would be taxed at 0%. Any dividends that are taxed at 15% would be taxed at 15% for income of up to $479,000 for married filing jointly, $239,500 for married filing separately, $452,400 for head of household filing status, and $425,800 for single taxpayers. If you have income above those threshold amounts, then a 20% tax rate on those dividends would apply. For other types of dividends, like stock dividends or stock splits, those are generally not going to be reported or taxable to the shareholders because they were not paid out to the shareholders in cash. They're usually still held in that brokerage account if it's a dividend that was paid in stock or a stock split. For dividends, if the dividend amount is more than $1,500, then Schedule B of Form 140 would need to be used to report those dividends. If the amount of dividends is less, then that can usually be reported directly on Form 1040. If a refund is received from a state or local government and the amount of the refund was used as a deduction for an itemized deduction in a prior tax year, then part of that refund may also need to be claimed as income. The taxable amount of that refund from a state or local government would either be the lesser of the amount that was received, or the amount that was deducted on a Schedule A, or the amount by which the itemized deductions exceeded the standard deduction that was allowable for that tax year. Social Security benefits can also be taxable. This mostly depends on the taxpayer's provisional income, which is also called the modified adjusted gross income. So we would need to calculate provisional income first and then compare it to the IRS published threshold amounts to determine if any of the Social Security benefits would be taxable. Provisional income is defined as adjusted gross income before the Social Security benefit, plus any interest on U.S. savings bonds that were excluded for educational purposes, most tax-exempt interest, employer-provided adoption benefits, excluded foreign income, deducted interest on educational loans, and deducted tuition and fees, and 50% of the Social Security benefits that were received. So to determine the taxability of the Social Security benefits, we're going to have to look at the threshold amounts that are shown in the following charts for married filing jointly, and also for single head of household or qualifying widower. So married filing jointly, the threshold amounts, the lower limit is $32,000 and the upper limit is $44,000. For a single head of household or qualifying widower, the lower limit is $25,000 and the upper limit is $34,000. So to determine the taxable portion, we have to look first to see if the modified adjusted gross income, that provisional income that we just calculated, is if it's between the limits of our thresholds, then the lesser of 50% of the benefits or 50% of the excess of provisional income over the lower amount of the threshold would be taxable. If the provisional income that is calculated is above the upper limit, then the lesser of either 85% of the benefits or 85% of the excess of provisional income over the upper limit, plus either the lesser of $6,000 for married filing jointly or $4,500 for single head of household qualifying widow, or 50% of the benefits would be taxable. So let's take an example, look at an example of how that works. We have Karen who files a return as a qualifying widow. She received $7,000 in Social Security benefits, $19,000 in interest income, and $5,000 in non-taxable municipal bond interest. So we calculate her provisional income as $27,500. So her provisional income would include half of the Social Security benefits, the $19,000 in interest income, and the $5,000 in non-taxable bond interest. So if we look at the threshold amounts for qualifying widower, she is between the lower limit and the upper limit. So she will need to report taxable Social Security benefits equal to the lesser of 50% of the benefits, which would be half of $7,000, so $3,500, or 50% of the excess of her provisional income over $25,000. So her provisional income was $27,500. So half of $2,500 would be $1,250. So her taxable benefits for Social Security that she would need to report on the tax return would be $1,250. Some other types of taxable income would include any pay for jury duty, prizes or awards that are received. If you win the lottery or you win a car on a game show, those would be taxable. Forgiveness of debt is taxable. You would receive a 1099-C from the bank that forgave the debt for any forgiveness of debt, and any insurance proceeds in excess of the adjusted basis of the property would be considered taxable income.